All right, let's talk about the stock market. We're going to crack it open by looking at one of the most wild financial stories you'll ever hear. It's a story about pure genius, massive risk, and a lesson that was learned way, way too late. Let's get into it. So, these are the words of the guy at the center of our story, Jesse Livermore. He was a legendary trader, and he saw the market as this amazing game of skill and psychology. But as we're about to see, even a master of the game can forget his own rules. Just to give you an idea of who we're dealing with, at his absolute peak during the 1929 market crash, Livermore made what would be in today's money $1.5 billion. He did it by betting against pretty much everyone else. But despite that unbelievable win, that's not where his story ends. He lost every single cent. So how does that happen, right? Well, that is the billion-dollar question we're here to figure out. So let's go back to the beginning. Let's look at the rise of the man they called the boy plunger, all because of his incredibly bold and, for a long time, unbelievably profitable debts. I mean, his whole journey is just incredible. He starts at 14 years old, just watching the numbers, feeling the pulse of the market. By his 20s, he's already a self-made millionaire. Then comes 1929, the Great Crash, where he becomes a legend, the Great Bear of Wall Street. But then, the fall. And what's so fascinating is that it wasn't because he misread the market. It was because he broke his own rules. He let emotion and ego get in the way. His story is actually the perfect way for us to get a handle on this stuff, because to really understand how somebody could win so big and then lose it all, we first got to understand what exactly was he trading. So let's just break it down to the absolute basics. Let's forget all the complicated jargon for a minute. At its heart, what even is a stock? You know, it's actually pretty simple. When you own a stock, you own a tiny piece of a company, like a little slice of the whole pie. And there are really two ways you can make money from it. One, the company gives you a share of its profits, that's called a dividend. Or two, the value of your slice, of your stock, just goes up. That's a capital gain. Okay, but not all stocks are the same. You've kind of got two main flavors. With common stock, you get basic ownership, and that means you actually get a say in how the company is run. You get voting rights. With preferred stock, on the other hand, you usually trade away that vote in exchange for a more predictable fixed payment. And this table really lays out that trade-off perfectly. See, common stock gives you that vote, but check out that liquidation row. If the company ever goes under, the preferred stockholders get their money back first. So here's the bottom line. Common stock has a higher potential for big returns, but it comes with more risk. Preferred stock is safer, but you probably won't see that massive, explosive growth. Okay, so from there, it gets even more interesting. Beyond just common and preferred, stocks get grouped into categories based on how they behave. Think of them like different tools for different jobs. And you can really think about these categories based on your own financial goals. So, are you looking for a steady paycheck? Well, income stocks are known for paying out high dividends. Are you betting on the next big thing? Growth stocks pour all their profits back into expanding the business, hoping for a huge jump in value down the line. And then, for the biggest risk, but potentially the biggest reward, you've got emerging stocks from young, unproven companies. Now, on top of matching a stock to your goals, you also have to think about the economic weather, right? And that's where these types come in. You've got your blue chips. These are the big, stable household names we all know. Then you have defensive stocks. These are your safe haven. They tend to do okay even when the economy is struggling. And the complete opposite of that are cyclical stocks. They ride the economic waves, they soar when times are good, but they fall hard when things go south. So we have all these different kinds of stocks, but where does all the buying and selling happen? And what is it that makes their prices go all over the place? Well, that brings us to the market itself. This is the arena. A securities exchange, like the New York Stock Exchange, is really just a marketplace. It's the central hub where all the buyers and all the sellers come together to trade these little pieces of companies. And believe me, this marketplace has moods. A bull market, that's when everyone's feeling optimistic, prices are climbing, and confidence is through the roof. A bear market is the exact opposite. Pessimism takes hold, people get scared, and prices fall for a long time. And Jesse Livermore, he made his billion-dollar fortune by perfectly timing the switch from a massive bull to a devastating bear. So what's really behind these huge swings? I mean, is it just cold, hard math? Is it how well a company is doing? What's the secret ingredient that's really pulling the strings here? Well, in the end, this is what it boils down to. A stock's price on any given day isn't some fixed true value. It's simply the price that millions of investors, with all their different hopes, their fears, their research, have collectively decided it's worth in that very moment. It's like a giant real-time poll on a company's future. And once you get that, you can start to understand the different ways people play the game. Do you try to ride those short-term waves of emotion and perception? Or do you ignore the noise and bet on the long-term value? This right here was Livermore's signature move. Short selling is basically a bet against a company. You borrow shares, you sell them right away, and you pray the price tanks. If it does, you buy the shares back for cheap, return them to the person you borrowed from, and you pocket the difference. It's super high pressure, incredibly risky, but as we saw with Livermore, the payout can be absolutely massive. Now, the polar opposite of that is this strategy: buy and hold. This is all about patience, not timing. The whole idea is that, yeah, markets have their mood swings, but over the long haul, good companies tend to grow. So you buy a piece of a solid company and you just hold on, collecting those dividends and riding out all the bumps along the way. And that brings us right back to where we started. Back to the man who could master the market's short-term swings, but couldn't seem to master himself. So what's the big takeaway from his incredible story? The ultimate lesson here is pretty powerful. Livermore could read the market's next move like nobody's business. His analysis was genius level. But when he started breaking his own rules, letting his ego take the wheel, and making these emotionally charged bets, that's when he lost everything. His mind was his greatest strength, but his lack of discipline was his fatal flaw. And really, that's the question his story leaves us with, isn't it? He's proof that even the most brilliant market timer in the world can be taken down by their own human nature. It really makes you think about what matters more in the long run. Thanks for diving into this with me.